That is bullish. That is better for precious metals than when gold is leading. The biggest bull markets for precious metals are when silver leads gold. So we already went through the first leg where gold led silver, and that leg got us to $5,000 gold. This new leg where silver is leading gold is going to get us to 10,000 or higher gold, but much, much higher silver. And again, this is not just a precious metals bull market.
A 7% move is an outsized move. And it goes hand in hand with what Bank of America, their lead metals analyst, was talking about recently when he said gold could go between $130 and $309 an ounce by the end of this year, based upon the gold-silver ratio, which is way out of whack. Well, what you saw yesterday is gold move up less than 0.5% and silver move up 7%. That is kind of the trajectory of what he is talking about. But
gold and silver are moving into a different phase. And the message from Andy Schectman and Peter Schiff is clear. This is no longer just a normal precious metals rally. Schiff argues that the real story is not nominal interest rates, but collapsing real rates. If inflation keeps rising while the Fed stays behind the curve, the dollar loses purchasing power even when official rates look high. That is why gold and silver can stay resilient even after hotter inflation numbers. And Schectman adds the physical market side of story. Silver is beginning to lead gold, and both speakers see that as a major bullish signal. Schiff says the first leg of the move, led by gold, already pushed gold towards $5,000. Now that silver is leading, he believes gold could move towards $10,000 or higher, while silver could move much more aggressively. Schectman also points to extreme gold-silver ratio pressure, Bank of America's silver target range, and large physical withdrawals from COMEX as sign that the paper price may be hiding deeper stress in the real market. Now, we present the clips from their interview. Before we discuss this, please hit the like button, subscribe to the channel and ring the bell icon. Thank you and enjoy the video.
All of the attention that is on nominal interest rates and whether the Fed will or will not cut them or maybe even hike them, right? People are talking about, hey, maybe the Fed might hike rates, even though they still have an easing bias, that it's possible that they might hike rates. So everybody is focusing on what the Fed may potentially do with nominal interest rates. But they're missing the forest for the trees, because what's really important is what's actually happening with real interest rates. Because real interest rates are plunging as inflation is soaring. If inflation is going from 3% to 6%, that is a 300 basis point cut in real interest rates while the Fed sits on its hands and does nothing. So forget about what they might and may not do with nominal rates. Look at what is actually happening right now with real rates, because that's all that counts anyway. Nominal rates don't matter. I mean, what if the Fed raises rates to 10% and inflation is 20%, right? Is that a reason to hold dollars? No, you're going to lose 10%. The 10% interest only covers half of what you lose to inflation. And of course, what if you have to pay taxes on that 10%? You got 6% left, but you lost 20. So nominal rates don't matter. It's real rates that count, and real rates are crashing, which is why gold and silver should be going through the roof. Now, what happened today, though, even though gold and silver went down, gold didn't go down that much, and silver didn't stay down. In fact, it rallied a couple of bucks positive. It recovered its losses and went positive. In fact, intraday, silver got to over $89. Let me see where it is right now, because it's pulled back intraday, and now it's 88.20. So, but it's still positive on the day and up another 80 cents tonight, despite the fact that we got the hotter than expected PPI number. Now, of course, the hotter than expected PPI number is actually bullish for gold and silver. It's just that traders don't realize that yet, because they're still fixated on what the Fed might do with interest rates in a nominal sense, and they're missing the bigger picture with what's actually happening in a real sense. and gold's up about 15 bucks. So we're back above 4,700, but you have a lot of resiliency here. But we are very close to gold and silver prices exploding, even with hotter than expected inflation numbers. And then the hotter than expected inflation numbers will be bullish for gold and silver because the Fed can't react. Again, even if the Fed hikes 25 basis points, 50 basis points, means nothing. The Fed needs to hike 200 basis points, 300 basis points. Do you think that's going to happen? I mean, well, Trump would blow a gasket. He'd have to fire everybody at the Fed. In fact, I'm surprised he hasn't already fired whoever it was that released the PPI numbers. Maybe it's because he knows no one really watches the PPI numbers. And so there's probably going to be a lot of pressure from people at the, that keeps the statistics if they want to keep their jobs, right? Because Trump, he already has a history of shooting the messenger when it comes to bad inflation news. But I've been talking about the underlying strength in silver. Silver has been very strong. It has been, more resilient than gold. Even when gold is down, silver is up. So silver is now leading gold. And as I've said many times, that is bullish. That is better for precious metals than when gold is leading. The biggest bull markets for precious metals are when silver leads gold. So we already went through the first leg where gold led silver, and that leg got us to $5,000 gold. This new leg where silver is leading gold is going to get us to 10,000 or higher gold, but much, much higher silver. And again, this is not just a precious metals bull market. It is a metals bull market. Copper soared, hitting a new all-time high today, even though it ended up down slightly on the day. It hit a new record above $6.70 a pound for copper. Think about this. Donald Trump talks about how bad the inflation was under Biden. Well, Biden was president for 48 months, right? 4 years. During that time, copper prices rose by about 17%. During the entire four years Biden was president. Trump's been in office now for about 16 months. And during that time, copper prices are up almost 70%. 70%. Now, I know some people say, well, that's just copper. Well, you know what? There are a lot of other prices that are going up. But copper is a pretty good bellwether of inflationary pressures in the market. So how can he say with a straight face, or anybody, that inflation is so much lower now than when Biden was president, when you have copper up so much more? In fact, it's not even going to stop. This is going to be a huge move. Copper is the new silver as far as where the prices are likely to go. But oil, over $100 a barrel. I think we're $102, $103 a barrel. Those prices have a long way to go because the Strait of Hormuz is a long way from opening. But wait until the dollar rolls over and Forex traders realize this.
The deeper warning is that inflation is not being contained. It is being disguised. Schiff explains that a small Fed hike means almost nothing if inflation is rising faster than the Fed's rate hikes. In that government, savers are still losing money in real terms, and hard assets become more attractive. This is why he believes hotter inflation can actually become bullish for gold and silver once the market realizes the Fed cannot respond strongly enough. Schectman focuses on the physical squeeze. He highlights record silver demand from China, strong buying from India, and significant metal leaving COMEX. He also explains that rising margin requirements can force selling in paper markets, even while physical buyers quietly accumulate. That creates a dangerous gap between price action and real supply. If silver continues to lead, the move could become faster than most investors expect. Now, let's get back to the interview.
There was a time when the folks at GATA who whenever I get a chance to throw out a shout out to Bill Murphy and Chris Powell, anyone who owns gold owes them a debt of gratitude and they have my respect. They always used to say gold and silver will never be allowed to move more than 2% in a day. And that's true. It never did. I've been doing this for over 35 years. It never did. A 7% move is an outsized move. And it goes hand in hand with what Bank of America, their lead metals analyst, was talking about recently when he said gold could go between $130 and $309 an ounce by the end of this year, based upon the gold-silver ratio, which is way out of whack. Well, what you saw yesterday is gold move up less than 0.5% and silver move up 7%. That is kind of the trajectory of what he is talking about. But look, when China imports more silver in the first first 90 days of the year than they ever have in the history of the country, as the price was being decimated, when India has been buying it, like I said, close to 900 million ounces over the last 3 years, when silver is being taken off the COMEX exchange and levels that no one has ever seen before. In February, as the price was being destroyed here in the United States, well, what happened on COMEX? About 26 million ounces were delivered. Now, that's not a big delivery month. It was not a primary delivery month. They are, it would be January, not February, March, not April, these kinds of things. And so every other month, but 26 million ounces were delivered in February, but 39 million ounces, Kai, got on trucks and drove away. That's 2.8 million pounds. Who in God's green earth took possession of 2.8 million pounds of silver here in the United States and New York, put them on semi-trucks and drove away? But it's the same thing we're seeing. Price is a tool of misdirection. And I think that silver is from a standpoint of asymmetric measurement, low downside, high upside, I don't think there's a better buy on the planet. But you could talk about things like, China, which was a net exporter through last year, is now a net importer this year. They're not exporting anything. We remember they pushed back to the United States classifying silver as a critical mineral and said, fine, we're not going to export that much. But most people miss what they said a few months earlier in November, as the second largest producer in the world said, we're not going to send any of our domestic production out into the marketplace outside of China. And then you look at their restrictions on sulfuric acid exports, which is beginning to show itself in fertilizer, as Mosaic, a big company, said we have to massively change our guidance for this year as fertilizer is becoming too difficult to make because of the cost of sulfuric acid. But sulfuric acid is also needed copiously in the production and mining of copper. When you look at silver, only about 20% of the silver mined last year came from companies like First Majestic, solely looking for silver. A majority of it came from byproduct mining, largely of copper, zinc and lead too, but mostly copper. Well, if the sulfuric acid doesn't allow you to mine copper quite as well, nowhere near as well or at all, then what's going to happen to silver production? And these copper mines, look, they don't have any incentive price-wise to go looking for silver. They stumble across it when they're mining copper. All of these things are starting to come into play. The massive deliveries that we're seeing all around the globe is certainly betraying the price of it all. And look, the pullback that we saw in the beginning of the year, the Bank of International Settlements, the most powerful bank in the world, came out and said, look, this was structural, not fundamental. Two reasons why it collapsed. Number one, at the end of every year, the beginning of January, you have a rebalancing of the levered ETFs. And that time frame, the first 2 weeks of January, is notorious for volatility in commodity markets because of the ETF rebalancing. Now, think of what happened up to January. Every week after week after week after week, silver was flying. They needed to rebalance those ETFs, right? So that means they sell silver within the leverage ETF in order to get their balance sheet in line with their prospectus. You could have bet dollars to donuts this was going to happen. Well, at the same time, the CME group, in their infinite wisdom, in 6-week period from the beginning of December to mid-January, right when you wouldn't want to do this, jacked up margin rates. That is the collateral that needs to be held to either speculate or to hedge a position on COMEX, 300%. So between the massively rising cost of margin, massively, from roughly $15,000 to hedge a 5,000 ounce contract on December 1st to $54,000 for that same contract, just in the margin account, 6 weeks later, along with the rebalancing, made everyone sell, beget selling, beget selling, beget selling, beget selling. Price collapses, and then you see China come in and scoop up more than they ever have in history. 39 million ounces leave the COMEX. We're seeing the biggest, most sophisticated, well-funded money on the planet who does not use margin look at any pullback as an opportunity to get longer. And here again, price is a tool of misdirection. They use a synthetic orchestrated means of raising margins and rebalancing ETFs to hammer the price, and then the big money says, "Ha ha, thank you," and grabs it all and puts it in their coffers at subsidized prices. And no one's even looking or paying attention because they're all licking their wounds about silver that absolutely collapsed and crushed them. That's what you call misdirection, my friend, and it's everywhere. In essence, what it truly is as what it's always been. It's been the central bank the central bank and through the commercial banks' ability to suppress the paper price. But what is breaking the paper price, Guy, is as they go and do this, as they hold it down, we see countries like China who purchased 160,000 ounces of gold in March. They added another 260,000 in April. That's almost 9 times the monthly purchase amount from year over year, from last year to this year. And this is when the price was getting its teeth kicked in. After 18 consecutive months of adding gold, you would think people would understand that price is nothing but a tool of misdirection. The narrative that we are being told is hogwash, as the biggest money in the world stands for delivery. And it's not just China, we're seeing it elsewhere, but they're a good example of what it is I'm talking about. And by the way, I know we're going to talk about silver, but in February and March, after the price was destroyed in silver, China bought more silver and imported more silver in those months, the largest ever in February, and then the largest still, setting an all-time record in March of silver, more than they've ever imported in the history of the country, as the price was being decimated. Price is a tool of misdirection, and the big money, the sophisticated money, who understands this, who's been using the Western suppression against us for a long time by standing for delivery, it's accelerating. And nowhere do you see that better than in the import-export numbers into China.
This discussion comes down to one central idea. The precious metals market may be entering a phase in which physical reality begins to overpower paper pricing. Andy Schectman points to China, India, COMEX withdrawals, and growing global demand as evidence that the bigger players are using weakness to accumulate. Peterschiff argues that the macro setup is just as powerful because real interest rates are falling. Inflationary pressures are building, and the Fed has limited room to fight back without damaging the economy. The prediction is direct and bold. Schiff sees silver leading the next major advance, potentially pushing gold towards $10,000 or more, while silver could surge even higher. Schectman supports this view, citing physical shortages, tight supply, and distorted paper markets. Together, they caution that the public may focus on daily price moves while the real story unfolds beneath the surface. For investors, the message is not about chasing every spike. It is about understanding why gold and silver are being repriced amid inflation, currency weakness, and rising distrust in paper assets. Share your thoughts about this interview in the comment section below. If you find this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.